China's economy is taking some massive hits and cracks are starting to show in the armor. First, let's do a quick roundup of the latest blows to China's economic powerhouse. Trade war tensions with the US, massive debt levels, slowdown in manufacturing and consumption, the ever-growing shadow banking system. These four factors have significantly impacted the balance between growth and financial stability in the country, and we're just scratching the surface here. Let's talk specifically about why these fresh headwinds could tumble China's house of cards. But first remember, it's you guys, the viewers, who bring these subjects to life, so don't forget to share your thoughts and opinions in the comments section. China's miracle growth was unproductive. China's growth rate has been fueled by an aggressive pursuit of infrastructure projects, as well as excessive lending and monetary stimulus. While this strategy initially worked wonders, it has slowly turned sour with massive debt levels and a number of ghost cities as a result. Ghost cities, which are vast urban areas with minimal occupancy, are a prime example of overinvestment in non-productive assets in China. Billions of dollars have been spent on constructing residential buildings, commercial centers, and other facilities that now lie largely empty or underused. This phenomenon reflects the consequences of exuberant spending on real estate by the government, corporations, and individuals, fueled by the easy availability of credit. Moreover, China's regional governments have also contributed to overinvestment by pouring resources into grandiose infrastructure projects, often with the intention of showcasing regional development and generating short-term economic growth. This has led to the creation of gargantuan projects, such as bridges, highways, and airports, some of which struggle to find a functional purpose. The result is a growing pile of underperforming assets, which weighs on local governments' balance sheets and raises questions over debt sustainability. However, the Communist Party leadership will have a difficult time reining in local government spending as they continue to put pressure on local leaders to reach unrealistic growth targets. China is still too dependent on exports. China's economy heavily relies on exports, and any disruption, like the trade war, can send shockwaves across the country. A reduced demand for their products can lead to slowed down production, resulting in employee layoffs and further hurt to the economy. These layoffs, in turn, feed a vicious cycle of consumer fear which is now sounding a deafening alarm. When looking at authoritarian government data that is as opaque as China's, there's no better measure of its economic health than prices. And unlike the rest of the world, China's prices for goods and services are going down. It's a nightmarish scenario that brings back memories of Japan's stagnation in the 1990s. There are several factors contributing to deflationary pressures in China. First and foremost, the nation's excess industrial capacity and overproduction led to a glut in supply that outpaces demand, causing prices to fall. Industries such as steel, cement, and coal have experienced significant price drops due to oversaturation in the market. The ongoing trade tensions between China and other nations, such as the United States, also contribute to reduced demand for some Chinese goods and services, further exacerbating the deflationary environment. Another contributing factor to deflation in China is the high levels of debt that both consumers and corporations are grappling with. As people and businesses focus on paying down debts instead of spending or investing, the demand for goods and services decreases. This in turn can lead to further declines in prices, creating a deflationary spiral. Deflation can have severe consequences for an economy. As prices fall, businesses may experience a decrease in revenue, leading to reduced profits and, potentially, job losses. This can result in lower consumer spending, which contributes to even lower demand and further downward pressure on prices. Furthermore, deflation can lead to a decrease in investments, as businesses and consumers may withhold spending in anticipation of even lower prices in the future. This can stifle economic progress and limit the potential for growth. There is significant financial system risk in China. The shadow banking system in China has continued to grow, exposing the country to high financial risks. Lack of stringent regulation in this sector has led to an increase in unrecoverable debt and, ultimately, a collapse-prone financial system. Even investments that were deemed safe for everyday Chinese people before are now toxic. Over the last few years, real estate in China has been a preferred investment option for many, which has led to exponential growth in property prices. This has resulted in a massive real estate bubble that might be on the brink of bursting. Country Garden, one of China's top real estate developers, is maneuvering rough waters amid the increasing fragility of the country's economy. The crisis Country Garden is facing can be attributed to numerous factors, particularly the massive amounts of debt it has accumulated along with a slowdown in the country's real estate market. Country Garden embarked on an aggressive expansion plan over the last decade, fueled largely by readily available credit in the market. This led to the accumulation of a substantial amount of debt, which has now become increasingly difficult to repay owing to the company's decreasing sales revenue and lowered new property prices. In addition to this, the high debt levels associated with Chinese consumers have reduced demand significantly. As potential buyers are prioritizing debt repayment over further spends such as house purchases, demand for real estate has declined, leading to significant pressures on property developers like Country Garden. Moreover, due to China's current macroeconomic instability and the ongoing concerns of a property market bubble, investor confidence in property developers like Country Garden is dwindling. The overall uncertainty tied with the real estate market also means that getting further credit has become harder for developers, intensifying their existing financial issues. This situation has resulted in many Chinese developers, including Country Garden, facing potential liquidity crises, thus reflecting on the broader systemic risk in China's financial system, especially since real estate contributes close to 30% of China's total economic activity, compared to real estate's share of just 22% in the United States. A housing crash in China could be worse than America's 2008 housing crisis. Collectively, these factors contribute to the crisis Country Garden is currently facing. It paints a larger picture of the complex, interconnected challenges lurking within China's economic landscape, underscoring the potential fragility of its financial system. These factors come at a bad time for China's ruling party, as they set expectations that growth would be robust after lifting stringent COVID-19 lockdowns. With a dire reality setting in, regular people who once traded their civil liberties in return for guaranteed economic prosperity may begin rethinking that arrangement with the government. The economic house of cards may turn out to be a political one as well. Thank you all for watching. Hit the like button on this video, leave a comment down below, and stay tuned.